Indian markets are at record high levels with the benchmark index Nifty currently on its longest winning streak stretching 13 sessions. Expectations of a rate cut in the US along with strong liquidity support, especially from domestic institutions and retail investors, have pushed the 50 share index over 5.5% higher from the recent low made on August 5th. Now, this low was triggered when the Bank of Japan surprised markets by raising interest rates, leading to an unwinding of yen-based carry trade, and a sharp correction across global equities followed. However, in less than a month, the Indian market has not only wiped out all those losses, but has also reached new lifetime highs. And whenever the market hits record high levels, a certain section of the investor community, known as the bears, start voicing concerns about overvaluation. And to their argument, the traditional indicators of valuation, whether it's the price to earnings ratio or the market cap to GDP ratio, do suggest that compared to historical valuations or other global economies for that matter, the Indian markets are currently expensive. And therein lies a shortfall of these indicators. They compare current valuations to the past to indicate whether a market is under, over or fairly valued. This narrative of valuation assumes that India will continue to grow at the same rate. However, if you ask the counterparts of the bears, the bulls, they'll tell you that India is on the cusp of a major economic transformation and that we are in for a decade or two of accelerated growth. So perhaps extrapolating the growth rate of the past into the future is a fallacy, and maybe the markets are not only fairly valued but could even be undervalued. To discuss and get deeper insight into this, we are joined by Aamar Deo Singh, Senior Vice President of Research at Angel One. Aamar, thank you for giving us time. Now, the Indian markets, they are on a 13-day winning streak. All the impact of this big crash that we saw on August 5th due to the unwinding of the Japanese yen carry trade has essentially been wiped out. What's driving the market?
Yeah, thank you for having me. See, definitely, if you look at the Indian markets, they are trading at a record high. So one of the major factors which I see is the global domestic flows, because liquidity is definitely driving the markets, because liquidity is the, I would say, the energy that really drives the markets. And if we see since April of this year, we've had more than 150,000 crores or domestic flows in this. So that's been very positive. Apart from that, we definitely had have had geopolitical tensions in Russia, Ukraine. So there was a time when it flared up. Currently, also it's on the scale is slightly higher. If you look at the Israel, Gaza, that also had scaled up. But despite all that, we haven't seen a spike in crude oil prices, energy prices. So energy prices, if you look at, they've corrected by 15-20% from the highs. So that has been, I would say, a positive for the global markets, because had energy prices, means crude oil, if you look at anywhere between $70, $75, $80, that's it. Otherwise, earlier it was trading almost $95, $100. So that correction in crude oil prices have eased this inflationary concerns, and also that has led to the, I would say, central banks across the world, including India, wherein we could witness some sort of rate cuts going forward, specifically what is being viewed from the US in September itself. So I think these are some of the positive factors. Apart from that, if you look at the global markets, global stock markets, many of them have been trading at record highs with the exception of China, definitely. So Chinese markets not performing has also helped our markets, because that has looked at by FIIs, but FII flows have not been as much as we would expect them to be. But that's the way it is. But the best part is that domestic flows have really taken off quite well, buoyed by the overall MF. If you look at the MF flows, SIP flows, they have really helped the markets. And it has been a broad-based rally across sectors. So some of the sectors like auto, pharma, IT, they've really helped the market sustain, apart from FMCG as well. So the interest of the, I would say, investors have been there, but yes, there is caution also at the same time.
Which of these is a more accurate measure of a country's stock market valuation? The market cap to GDP ratio, the price to earnings ratio, discounted cash flow analysis, or is there any other measure or metric that you prefer?
As you rightly said, these are few important metrics which one needs to keep a close watch on, be it the price to earnings ratio or the market cap to GDP ratio or the discounted cash flows. But if you look at the overall Indian scenario, first I'll talk about the market cap to GDP ratio. So anywhere, if you look at how it works, is that if it is above 90 and higher, then that could be maybe overvalued. If you look at between 75 to 90, that could be basically fair valued. If it is below that level, so between 50
Hmm.
75, that's undervalued. So we are definitely on the higher side. If you look at March last year, that was close to 95, 96%. Currently, we are in excess of, I think, 140% or so. So in terms of the market cap to GDP ratio, we are slightly on the higher side, on the expensive side, no doubt. And this also called the Buffett indicator. So people definitely keep a close watch on this.
Hmm.
Having said that, if you look at the current Nifty PE, because if you look at the 5-year average, that's somewhere around 25. If you look at the current P, that's around 23.47, somewhere around 23, 24. So
Hmm.
from that perspective, overall, the markets is not as expensive as they appear to be. So
Hmm.
what's happening is that investors definitely, these are more challenging times wherein identifying stocks from a long-term perspective is not easy, because
Hmm.
most of the stocks, because you have to understand that money flows in not all the stocks which are there. It's I would say a set of stocks. So it could be few hundreds of stocks which really have that sort of liquidity to take in all the inflows. So that
Hmm.
is because, and the sort of money flows that we are witnessing from mutual funds, from SIP, that money has to be invested. Now, where's that
Hmm.
money going to go into? It's going to go into those set of stocks only which are
Hmm.
high on corporate governance, which have a growth potential and which have been doing the right things. So
Hmm.
then that number comes down significantly, because we've got thousands of stocks, but are all being invested in that way? No.
Hmm.
So it becomes a challenge for investors. But having said that, I wouldn't say that we are extremely expensive. Yes, there are pockets of expensive stocks which are there. We did witness
Hmm.
some of them, like the PSU stocks, where we witnessed some sort of correction. So that's part of a, I would say, healthy correction which is there. So these are two, I would say, major indicators one should definitely keep a close watch on. In terms
Hmm.
of Nifty PE, we've seen it cross 40 as well.
Hmm.
So currently it's around 23, 24. So that's within. So the important point is, how do the corporates? Because if you look at the US markets, the corporate earnings, the quarter earnings, they are
Hmm.
now over. So we have to watch out how they perform. So going forward, so it's primarily the view or is towards how the corporates continue to perform
Hmm.
quarter on quarter. That's one, and also how the US Federal Reserve is actually looking at. So these are
Hmm.
some important points too.
Amar, I feel the shortfall of these indicators lie in the fact that they are relative measures of value with comparisons made against historical averages. However, most experts that we have spoken to, and including you, sir, suggest that India is on the cusp of a major economic transformation. So, if you believe in that argument, would it not be unwise to extrapolate past growth to determine whether the market is under, over, or fairly valued?
So there's a very nice thing I'd like to say, that price and value, they are tied by a mile-long rubber band. So sometimes you'll find that the price and the valuation, the stretch is very much. Sometimes it's so there that definitely is a challenge for investors, as I've said, because many of the stocks, if you look at the PE, they'll be in triple digits
Hmm.
in many stocks. PE
Hmm.
is in triple digits. So the point is that, do you really invest in that, or you wait for some correction? So that's a call that investors will have to take based on their risk appetite. So now we've got so many types of instruments, like you've got the index ETFs, you've got sectoral ETFs, you have an opportunity of stock SIPs and all that. So you can look at it from that perspective. Secondly,
Hmm.
as you rightly said, that we are definitely India's growth story is there and intact. So if you look at the other nations, like I would say Russia, they are in serious trouble. If you look at China, again, was growing very fast. They have come down significantly.
Hmm.
And also because primarily it's a debt issue. So
Hmm.
going forward, how does India manage its debt? is something which is going to be very important, because the sort of money that's required for our infrastructure development, that runs into hundreds of billions of dollars. So the execution is going to be very important, and also the wealth that is being created, how spread that is, so that the concentration of the wealth, or whether the wealth is really being distributed across the population, that's going to play a very important role. Apart from that, if you look at the Indian markets, there is this opportunity of growth. There's no doubt about it. The size of the middle class, the size of the consumption class is unparalleled. So these are certain factors which definitely work in our favor, and most importantly, it's a political stability. So which we've been witnessing for quite, despite being we having coalition governments. Also, we've seen that governments have delivered from time to time, and currently we are having again a coalition government. So despite that, markets have given a thumbs up. That really shows that Indian democracy is very mature, and we are able to face the challenges. So these are certain aspects which are working to our advantage compared to most of the other countries which lack this.
Okay, so I understand that from a relative standpoint, we are in an overvalued territory. But for the benefit of our viewers, should they be concerned about it? And what are the factors that could derail this trajectory India is on?
Generally, there's something that reasons come out all of a sudden. So just to give you what could be probable reasons. So maybe a weakening of the rupee. So if the rupee continues to weaken significantly, then that's definitely a cause of concern, because our imports are going to be really, that will hit us so on our deficit side. So that's one area we have to watch out for. Apart from that, any sudden emergence of a global threat, maybe we've seen this China-Taiwan issue is there lingering in the background, but we never know when it could really flare up. And there is a possibility that it could flare up in a couple of years. So that possibility cannot be ruled out. Just like the Russia-Ukraine issue was festering for quite some time, and then it eventually exploded. So the China-Taiwan issue is also an issue which is on the back burner. The longer it remains in the back burner, the better it is. But if it escalates, it could have a serious impact on not our markets, but global markets as well. And also, I would say crude oil prices, another one factor, which is something that could upset the apple cart, not only for India, but for global markets as well, because any spike is okay, but sustained increase in crude oil prices, that definitely could be a cause of concern. And in case there is any political instability in the country, because we are no longer a full party rule. So any political instability could have a short-term impact. But these are impacts which, if you look at any market from a long-term perspective, Indian markets from a long-term 10, 20 years, so many events have happened which have really brought the markets down on its knees. But then the markets have bounced back. It's like so that a fundamental structure and fundamental strength is definitely there in our market. So the fundamental drivers are present here in India. From a long-term perspective, you look at the markets, definitely you've got so many types of instruments which I talked about, depending upon the risk appetite. That's very important. Investors need to understand two things: what is their risk appetite, and secondly, how long are they willing to invest, and are they going to do it in a systematic and disciplined manner? If these three things fall in place, then definitely there isn't much cause of worry, and corrections need to be bought into. While at the same time, one needs to be very clear as to not get into stocks which are into controversy, not get into stocks like penny stocks and all that, or which are really, there's not much fundamentals which are driving. So stay away from those. That's also very important from a long-term perspective as well.